Hey, welcome. Today we're diving into what I like to call a secret weapon for a lot of investors, especially if you're in a higher tax bracket. We're talking about municipal bonds. Let's really get into what makes these such a powerful financial tool.
But first, let me just ask you this. Think about your portfolio's earnings for a second. Now, after the government gets its slice of the pie, how much are you actually getting to keep? Yeah, for a lot of folks in those higher brackets, the answer can be pretty darn frustrating.
So, what if I told you there's an investment out there that's not only designed to tackle that exact tax problem, but also helps build the very communities that we all live in? Well, that's exactly what municipal bonds, or as you'll hear them called, munis, are all about. Okay, so what is a muni bond really? The simplest way to think about it is it's a loan. You are lending your money to a local government, like your city, your state, maybe even a school district, so they can pay for big public projects. And in return for that loan, they promise to pay you back with interest. And what kind of projects are we talking about here? Well, think about the absolute backbone of our daily lives. I'm talking about the roads we drive on every day, the schools our kids go to, the hospitals that take care of us, even the hidden systems that bring clean water right to our taps. That's the kind of essential stuff these bonds help make a reality. So look, helping your community, that feels great, right? But the real reason munis are so incredibly popular with savvy investors is because of their unique superpower. They have this amazing tax advantage that's hard to beat. And here it is. This is the whole ballgame right here. The interest you earn from most municipal bonds is completely 100% exempt from federal income tax. And it gets even better. In many cases, if you buy a bond issued by the state you live in, the interest can be free from state and local taxes too. It's a triple threat. Now, to really wrap your head around just how powerful this is, we've got to talk about something called the taxable equivalent yield. I know, it sounds a little complicated, but it's really just a fancy way of asking a simple question. How much would a normal taxable investment have to earn to give me the same amount of cash in my pocket as this tax-free muni bond? Let's just walk through the math together. It's pretty straightforward. So let's say you find a muni bond that's paying a 3% yield. And let's say your marginal tax rate, that's the tax you pay on your next dollar of income, is a hefty 40%. Okay, so you take that 3% yield and you divide it by 1 minus your tax rate, which is 0.40. What do you get? You get 5%. And that's the magic right there. For you, that 3% tax-free muni is just as good as finding a regular corporate bond paying 5%. And this chart just makes it crystal clear. Look at those two bars. The taxable bond on the left, it starts out looking better at 5%, right? But wham, after that 40% tax hit, what you actually keep shrinks all the way down to a 3% return. Now look at the muni bond. It starts at 3%, and because there's no federal tax, it stays at 3%. Your take-home pay is exactly the same. That is what we call tax efficiency in action. But of course, it's not always that simple. Like with any investment, you have to know what you're getting into. The truth is, not all municipal bonds are created equal. So let's break down the different types you'll see, and, just as importantly, the risks you need to keep on your radar. So basically, there are two main flavors of munis. First, you've got general obligation bonds, or GO bonds. These are backed by the full faith and credit of the government that issues them, which is basically their ability to collect taxes. Because of that, they're generally seen as very safe. Then, on the other hand, you have revenue bonds. These are paid back with the money made from a specific project, like, say, the tolls you paid across a new bridge. So their safety really depends on whether that project is a financial success. Now let's talk risks. First up is interest rate risk. This just means if interest rates in the wider market go up, your older bond that's paying a lower rate suddenly doesn't look as attractive, so its price could drop. Second, there's default risk. Now, it is pretty rare, but it's not impossible for a city or county to hit hard times and not be able to pay its debts. And finally, you have liquidity risk. Some bonds, especially ones from really small issuers, might be tough to sell in a hurry if you need your cash back. So how do you protect yourself against that default risk? Well, the single most important thing you can do is check the bond's credit rating. Agencies like Moody's or S&P issue these ratings. Honestly, you should think of it like a financial report card for the city or state. It's an absolutely essential part of doing your homework. So when you put all these pieces together, what role do municipal bonds actually play in your overall investment strategy? Let's zoom out for a second and look at how they fit into the bigger picture of your portfolio. You'll often hear financial experts talk about municipal bonds as a defensive player on your investment team. They're not the flashy quarterback trying to score huge points. Now, their job is different. Their job is to protect your capital and bring some real stability to your portfolio. So, what does a defender actually do for you? Well, for one, it gives you a stable, predictable stream of income you can count on. Two, it helps preserve the capital you've worked so hard for because it's generally way less volatile than the stock market. And three, as we've seen, it's a master at shielding your returns from the bite of high taxes. So I'll leave you with this final thought. When you look at your own financial plan, at your own team, do you have that strong, reliable defender working for you? If stability and tax efficiency are what you're looking for, it might just be the missing piece you need. Thanks so much for tuning in.